Welcome back. Today we're looking at a fascinating analysis report on PayPal.
Right, the one titled PYPL Stock Forecast. The 2026 reversal begins now?
That's the one. It presents a really strong contrarian bullish case for the stock.
Arguing it's set for a pretty significant valuation reversal by 2026?
Exactly. All based on a suppressed PE and, that really robust free cash flow. So let's just get straight into it.
Let's do it.
As I see it, the report's main challenge is really tackling that dominant market narrative. The fear.
Oh, absolutely. The fear around structural competition. I mean, it does a great job identifying the core bear thesis.
It names the names, Apple Pay, branded checkout share loss.
And it frames this whole narrative as a bear trap or a sentiment washout.
Which is a strong hook. But is it enough?
Well, that's the thing, and that brings us to our first key topic sentence. To maximize the robustness of the bullish case, the analysis must integrate a quantifiable defense strategy against the central competitive headwinds.
Okay, so it needs more than just a catchy label. It has to have the math to really back that claim up. What's the weakness you see there?
The weakness is that the report treats these huge structural issues purely as market emotion, as a narrative.
Like it's just a feeling. A sentiment washout, as it says.
Exactly. So it correctly points out that the street is scared. You see Morgan Stanley's $51 target, you hear about share loss, and people get nervous.
Of course.
But by just labeling it a sentiment issue, the analysis confirms the problem exists, but it doesn't mathematically prove why that problem is, either already priced in or fully mitigated.
So it acknowledges the leak in the boat, but doesn't really prove the boat won't sink.
That's a perfect analogy. An expert eye is going to notice that immediately. They'll say, okay, you see the problem, but you haven't diffused it for me.
Right. So what's the suggestion? How do we shift this from an emotional argument to one about financial durability?
The suggestion is to move beyond just calling it a bear trap. The analysis has to quantify how PayPal's cost cuts and its immense free cash flow generation.
What was it, $2.3 billion in Q3 alone?
Something huge like that, yeah. You need to show how that cash acts as a structural financial buffer against this revenue erosion.
I like that framing, a financial buffer. It anchors the whole thing in real numbers.
It does. It makes it concrete.
So give me some examples. How do we present that without just dropping a spreadsheet into the report?
You can use some really targeted high-impact examples. For instance, the analysis could introduce a quick sensitivity test.
Okay.
It doesn't need to be some huge appendix. Just a simple illustration of how much branded checkout revenue PayPal can afford to lose while still justifying that $72 base case target.
That immediately shows the downside math has been done. It adds so much credibility.
Instantly. And a second thing is to just pivot the language. Stop saying the selling is exhausted.
And say what instead?
Rephrase it to something like, the valuation at under 12x PE is so compressed that it has already implicitly priced in an X% annual deceleration due to competition.
So you're turning the bear case on its head. The fear is the opportunity.
You're turning their thesis into your entry point. And one last thing.
Go on.
You explicitly show the minimum sustained free cash flow that's required to maintain that $58 support level.
Ah, so you're grounding the technical chart pattern in fundamental finance.
Exactly. You're reinforcing that the concrete floor isn't just a line on a chart. It's built on a foundation of billions in cash.
That's a powerful shift. It really strengthens the entire thesis. Okay, so that shores up the foundation. Now, what about the path to the high end?
A different beast entirely.
Right. The report establishes a very strong value case, which gets you to that base target. But the bull case is $90, maybe $100.
And that requires a return to a growth valuation. We're talking a multiple closer to 30, not 15.
Which is a huge leap.
It is. And that leads directly to our second topic sentence. For the analysis to fully support the higher price targets, the specific, future-oriented operational catalysts must be defined beyond general references to management focus or new CEO initiatives.
So the valuation is stupid cheap argument only gets you so far.
It gets you to the base case. It gets you that mean reversion rally. But the weakness here is that the report attributes that massive re-rating to vague ideas like new CEO initiatives work.
Or margin expansion returns.
Yes, but how? What are these initiatives? What drives that margin expansion? Without defining those engines of future profit, the $90 target, frankly, it lacks analytical foundation.
You're asking the reader to take a leap of faith.
You are. You're telling them to forget the last 5 years and focus on the future. But you haven't painted a clear picture of what that future actually looks like.
Okay, but what if those initiatives are still under wraps? I mean, how can an analyst define them without insider information?
Oh, it's not about that. It's about inferring the source of the margin improvement from what the company has said.
Okay.
The suggestion is to specify the 2 or 3 most critical future mechanisms, the actual sources of that new profit that will justify the bull case. You have to tell the story of how they start growing again.
Got it. So connecting the dots that are already there, how do we make that tangible in the report?
You start with efficiency. The analysis should detail the specific levers for cost-cutting that led management to raise 2025 EPS guidance to what? Over $5.30.
Right. They did raise it.
So you establish a clear, measurable link. These current efficiency gains are the first step toward greater margin expansion in 2026.
That's the first rung on the ladder. But what about the revenue side? You need more than just cuts for a growth multiple.
Absolutely. So next, you have to pick a lane. You clearly articulate which future product or market segment is the primary engine for unlocking that $90 target.
For example?
Is it unbranded processing growth finally moving the needle? Is it an acceleration of Venmo monetization? Pick one or two and build a narrative around their potential contribution.
That moves the conversation from just hope into a focused, segment-specific potential.
Finally, you explicitly link the capital return strategy, the buybacks, to the higher EPS figures that are needed to drive the base case. Then you show how the growth initiatives are what take the stock from that cheapened PE to a true growth multiple.
That separation is so important. Buybacks create value, but new initiatives create growth.
You need both for the full story to work, and defining those future bits is just crucial for credibility.
It is. Okay, let's look at the structure of the price targets themselves, specifically that transition between the base case and the bull case.
Yeah, there's a huge opportunity here to refine the flow and make it even more impactful.
So what's the topic sentence for this one?
The report should employ a clear, multi-stage structure that delineates the path from the inevitable value reset to the contingent growth re-rating.
A path. I like that. So what's the weakness in how it's currently structured?
Right now, the report defines the base case, that $72 to $78 range, as a 50% probability event.
And the bull case, 90 to 100, is a 30% probability.
Correct. They're presented as distinct, almost standalone outcomes. It kind of leaves the reader wondering, can the stock get to $90 without first hitting 78?
The logical connection isn't explicit. It feels more like a list of possibilities than a strategy.
Exactly. It's not a ladder of credibility, and that's the suggestion for improvement. Clearly frame the base case as stage 1, the realization of that coiled spring mean reversion.
And the bull case?
The bull case becomes stage 2, the market's subsequent validation of those new defined initiatives we just talked about.
So you have to earn the right to the bull case by proving the base case first.
Precisely. It provides a clear, executable investment pathway. It stops being a roll of the dice and becomes a logical progression.
Okay, so how do we make that staging concrete within the analysis itself?
You can start by explicitly connecting that for traders section, the entry near 58.50, with a short-term target of $66. You frame that as phase 1 of the stage 1 realization. You're showing how the technical stability is the first sign that the fundamental floor is holding.
I love that. The short-term trade becomes the proof of concept for the entire thesis?
Yes. Then you literally rename the rationales for the larger stages.
To what?
The base case rationale becomes stage 1, FCF and buyback-driven value reset. And the bull case rationale becomes stage 2, operational catalysts justify growth multiple.
You're dynamically linking the price targets. You're showing the market needs to see stage 1 succeed before it will grant the multiple for stage 2.
You got it. And this all has to tie together in the conclusion.
Of course.
That final verdict, the stop looking at the rearview mirror part, has to link directly back to this idea that the successful execution of those future initiatives is what lets the stock jump from a 15x PE to a 20x or 25x multiple.
The entire analysis then flows logically from depressed value to contingent growth. It's a much stronger narrative.
Much stronger.
This analysis has such a powerful core thesis. I mean, buying a global payments leader that's priced for disaster, but is still delivering massive profits.
It's a really compelling contrarian position, especially with that 2026 reversal timeline.